Well, hello everyone. Don Garman here from Mirador Capital Partners. Here again, we are done with Q1 2021 somehow, and I thought we'd just take a minute and catch you up on some of our thoughts going into Q2. This Friday starts the, I would say, all-important earnings season for the first quarter of 2021. So I got a quick question from somebody a couple days ago, and the gist of it was, why has the market been so resilient? It seems like we're on such tenuous ground. And I think last time we chatted, we talked about, the cross currents or swirling winds or whatever around rising interest rates. And clearly that has settled down for the time being. But I'm going to go back to an old chart that we used to look at a lot for those of you who go back on these videos for a little while, and look at really the sort of fundamental support for the market, or why the market is sort of hanging in as well as it is. And I want to set aside the societal implications of this statement, because it's pretty, it can be pretty stark if you start to think through what could in fact be happening. But the first thing we're going to look at is just the earnings expectations for the S&P 500, right? This is the 500 largest companies in the country. And when you look back over the last, from 2017 through to now, and in the estimates into the future, what you see is what we would expect, which is that with the economy shut basically from a year ago, and starting to reopen now, what you would expect is what we've seen, which is a big decline in earnings, but not as big of a decline as you might expect, because as we know, what happened is a lot of people, even though they weren't going in, they were still working on some level, making money, not spending a ton. And so companies on the corporate level, their expenses went way down. So their earnings in many cases didn't go down as much as you might have expected. And so what is now starting to happen is, as we're pricing in reopening, expenses are coming back into businesses more slowly than you might have predicted. It isn't like they're going back to the exact same expense structure that they had 2 years ago. And so what you're seeing is estimates over the next couple of years are quite a bit higher than they are, and the growth rate of those earnings is pretty drastic and dramatic in a positive way. So the second chart I want to add, or that I want to look at, is the number of revisions, the forward-looking estimate revisions. You can see that positive revisions are outnumbering negative revisions by a factor of 2 to 1. So in terms of support or bullishness about the future, it's hard for investors, institutional or individual, to make a strong case for jettisoning long-held positions when the estimates at this point are that future earnings will be so much larger than current earnings. That's generally the support for prices rising. What you might have expected is that in 2020, things would, that March, early pandemic flush, it would have been logical to suggest that that might have lasted longer. And then, of course, the government responded by lowering rates and sort of, borrowed, I think we're up to 6 trillion or so against future generations, because let's never forget that that money in theory and in reality has to be paid back. So, but we're not worried about that right now. The market's not worried about that. We're simply focused on the fact that, as the markets reopen, or the economy reopens and businesses going back to normal, we're going to have more revenue, not as high as expenses as we had a couple of years ago, therefore greater earnings and greater earnings growth, which is providing the support for where we are right now, which is why, as you've seen, we continue to sort of stay in the positions that we've been in. As we've seen, some of the ones we've added toward the end of last year have been standouts so far this year. And obviously we're expecting that to continue as we move forward here over the next couple months. So the little subplots about growth and value, these skirmishes that are happening around the market, we pay attention to. The goal largely is to not be in the middle of these hotly contested, big winner, big loser type debates, and preferring largely to stay in, the sort of fortress-like position that we're comfortable really in any economic condition being in. So that continues to be the playbook and the plan. As always, we're monitoring, and you'll see even today some new positions that we haven't owned for many years, but we're making a case for why we want to be in them over the next several. And so as we do, we start to build our positions and sort of plot along, as is always our practice. So anyway, happy belated Easter. I hope you had some time with your friends and family. Q1 behind, here we go into Q2, and we'll look forward to whatever the world brings. And as always, thank you for everything and the trust that you put in us, and we appreciate it. And if you have any questions, as always, let somebody know and we will get you answers. Thanks. Talk to you soon.